And welcome back, everybody, for part 2 of the Silver Institute's Silver Investment Update. Now we're going to jump in here and start to look at some of the fishy stuff that's in this report. First of all, the thing that jumps out at you, let me read their description here of the reason for the increase in the futures activity. They say, looking at recent trends, 2008 saw a 31% increase in turnover, with total volumes reaching more than 8.9 million contracts. Now, if you do the math on that, 8.9 million contracts times 5,000, that gives you roughly 45 billion ounces of silver. Now, the number's a lot higher than that, but that just goes to show you how much paper silver is being traded for physical. The data for combined non-commercial and non-reportable net positions in COMEX futures is considered as a proxy for investor activity on the exchange. It shows that the net investor long reached a peak of almost 76,000 contracts in February 2008, driven by spillover effects from gold's rally. Nevertheless, long positions then started to fall, reaching a low of 22,000 contracts in October of that year. This was due to the deepening financial and economic crisis and subsequent investor liquidations in order to cover losses elsewhere. So remember this point, they're always going to explain that the drop in silver is caused by the financial crisis causes those who have silver to sell their silver so they can cover financial losses elsewhere. But when we come over to this other page, when they're trying to explain the tremendous activity that we saw, they say 2010 saw a dramatic increase in silver futures turnover on the COMEX. The total volume reached 12.8 million contracts, a rise of 60% on the previous year's level. This was mainly driven by growing investor confidence in silver's underlying fundamentals, in particular the well-documented strength in industrial demand. Moreover, in recent years, the economic backdrop has remained supportive for investment demands in terms of the metal's safe haven appeal. So they're telling us that in economic crises, investors are going to run to silver, yet they just told us they're going to run away from it. And we'll see that here in these charts that we go to. Related to this is the rising investment activity in the silver market has been further driven by growing concerns over economic and financial difficulties in Europe and the United States. And then they give a disclaimer here. And the disclaimer is actually going to be about this chart. Now this chart is, the one on the left is COMEX net investor long positions, and that's just juxtaposed to the price of silver. The key chart we want to look at here is this one on the right. This is COMEX net investor long positions, and the green line is the net positions. Let's see, no, net positions in contract. That's gold. I'm sorry. That's the net positions in contracts for gold is the green, and the net positions in contracts for silver is the black line. Now what's interesting about this, or I should say the dark green line, my color blindness again, but the darker line here is the silver contracts, and you can see that the number of outstanding silver contracts nearing the midpoint of 2011 is actually lower than any other reported time except for all the way back in 2003. So how can you argue that silver is a safe haven when the investment in the futures has fallen to a level lower than when the bull market started? And you can see it's not true for gold. Gold has risen consistently. So there's definitely something fishy there. Keep that in mind as we talk about the next issues. Now we talk a little bit about the Shanghai and the foreign exchanges, and that's very interesting, but they're really a very small part. We want to remember to come back to this because we have the ETF holdings, and remember these hit in January this year 600 million ounces when we put together all of these ETFs. So keep that number in mind. Now, the silver ETF holdings are listed here. These are the various ETFs. 2009, you can see the increase to 2010. And I want to bring you to a chart that talks about it's actually at the very end here, so we'll just go down to the bottom. These charts at the very bottom talk about the available supply, or not available, but the estimated supply of privately held stocks. Now, it's a little bit unclear what they're talking about here, and as we go over to the breakdown of the supply and demand that's on the other page from the Silver Institute, it'll become more clear. But when we look over on the right here, when we have identifiable bullion stocks, we can see they actually break these out. And if you go back starting in 2001, you can see them clear. The key players are European dealers, government, COMEX, and others. Now, first off, the thing you're going to notice is that others is virtually nothing in any of these, so that's just irrelevant. The COMEX is just this small section. The larger section here, in the lightest portion, is consistently shrinking. Now, this makes sense because we know that the governments have pretty much dishoarded all of their silver and they don't have any left. And even the U.S. Mint has to buy from private suppliers. So we can see this number continuously shrinking, and you can see it went from about 300 there to about 850. So you're talking about 500 or so million ounces of silver that they were dishoarding, and now they're down to about maybe 50 to 100 if they're lucky. But what really strikes you, and then the other one, the COMEX, you can see is consistent all the way through. It's just this little 50 million, 50 to 75 million section. The section that really stands out is this European dealers section. And you can see that it jumps from about a little under 300 million to around 900 million from 2005 to 2010. So this group, whoever this group is, of European dealers accumulated roughly 600 million ounces of silver between 2005 and 2010. So who is this group? Well, I found an article, and it is by Franklin Sanders, and it is back from 2005, but it's called Where's the Silver, and he breaks down, this is his breakdown of one of the Silver Institute's studies that they did back in 2005. And this is one of the only articles I could find. That's interesting because I'm saying something fishy, and he says the red herring begins to stink. But he talks about this European stocks, and he says here on the above ground silver stocks, some silver stocks you can see and some you can't see. Some are like the reported stocks in the New York or Tokyo commodities exchanges or in government hands, and remember we saw those. So there's the exchanges. The other exchanges would be there. The COMEX consistently we can see there, and then what the government holds, that's pretty clear what those are. These are plainly visible. Others, like European dealer stocks, are invisible and must be estimated. GFMS estimates these at 332 million ounces at the end of 2004, about 3 times the COMEX stocks of 104 million ounces. As this leaves me a little nervous. As far as I know, there's no government mandate or even official account reporting required from these dealers. The dealers are notoriously tight-lipped about their business. Witness GFMS remark on page 32, obvious confidentiality issues with individual dealers. Since not every dealer will report stocks to GFMS, I reckon that they must infer the total. How? By statistical abstraction. Now, I'll venture to say that an increase in 600 million ounces in about 5 years, that is quite a statistical abstraction. So keep that in mind when we jump over to the Silver Institute's statistic page, and this is the key page that I want to look at. Now, the first thing we notice when we look at these statistics from the Silver Institute is they show how supply and demand have been growing fairly strongly over the last few years. And they actually give a breakdown. The first breakdown they give is all of the mined silver. Now, if you add all these top countries together, which is interesting in and of itself because it's Mexico, Peru, China, Australia, Chile, Bolivia, and the United States is 7th with a tiny 38.6 million ounces. But when you add all these together, you get 735.9 million ounces in 2010. Now that's very interesting because you can see that they estimate that in 2010 the total supply was 1,056,000,000 ounces of silver. So you have a discrepancy of approximately over 300 million ounces of silver that are part of the supply. Now, where did these come from? Now, I've looked at these tables before, and sometimes they're hard to understand, but I'll try to explain this. The first obvious key is mine production. This is the supply from years 2001 to 2010. You can see the mine production, and it was 606, 593, 596, 613, so hovering around 600 million ounces. You can see in 2005 it increased 637, 641, 665, and then 681 in 2008. It broke 700 and then 735 last year. Now, these really aren't very rapid increases. They're a decent percentage increase, but they're not nearly large enough to meet the growing demand. Now, the next line is net government sales. So we have millions of ounces that are being, and you can see this was the dishoarding by the government, the last of their millions and billions of ounces of silver that they had stockpiled over the years. Now, this is very interesting. They give a number of nearly 50 million ounces of silver being sold by what governments have silver. So I'd really like to know where they got that figure from. And then the other interesting figure is old silver scrap. They're saying that 215 million ounces came from silver scrap. That may be the case. I don't know if that's the case. That's a very high number. I would be very surprised. But that's possible. Could be all the old coins that are turned into the coin dealers and the old jewelry and all that stuff that's melted down for scrap. So we'll give them that. So we're still missing a 61 million ounces, and they list that as producer hedging. So producer hedging, I suppose what that means is the producers are selling, since this is adding to the supply of silver. That would mean that these producers had hedged a certain amount of silver and then dumped it in that year. So that could probably be added to this number of mine production, but I'm not really sure. The one thing that does jump out at you is they had to pull a really big number for the year of 2010 to get themselves to that billion mark. They needed to come up with 61 million ounces, which you can see they didn't have hardly any in any of the previous years, so that's a big number. The next one is the implied net disinvestment. Now that is a mirror image of down below under the demand you have the implied net investment. So implied net disinvestment adds to the supply of silver, while implied net investment is part of the demand. So we don't get any on this because they're going to imply it down below. So we have to look at demand before we look at that line, and that's going to be the key line that we're going to be talking about once we get through all of these. So the first line of demand, of course, is going to be industrial applications. You can see that 2008, actually 2009, probably a fall-off effect of 2008, the industrial fall-off was down from 492 to 403, and then it bounced back up. So there's been a general increase in the trend of the uses for industrial applications. Now with photography, it's been the opposite. It's been quite a fall off, and we're down to about 72 million now, but from 200, but the offtake from industrial has more than made up for that. The next line is the usage in jewelry. That's fairly steady. Silverware has fallen a little bit. That is to be expected and understandable. As the price of silver rises, it becomes more and more expensive to buy silverware. Now the coins and metals shows quite a jump, and this is a number that makes me a little bit suspicious. I would expect that number to be a lot larger. Nevertheless, you can see that the increase from 30 million or so in 2000 all the way up to 100 million, that's a tripling of coin and metal demand. So that's really big. And that gives us a total fabrication of 878 million ounces of silver out of about 1,056 million ounces. So there's no producer hedging in this, and then we get this number that's the implied net investment. So implied net investment, this is a number that would be implied to be gathered by whatever groups that are investing in physical silver. So for the year 2010, the total fabrication and coin demand was only 178 million ounces less than the total. Okay, so what am I getting at? Well, the question we want to look at is, first of all, we want to look at the figure for the European dealers. We know that the European dealers added approximately 600 million ounces between the years 2005 and 2010. We also know that the ETFs added, I believe it was 600 between the years. They started in 2006. This is the dollar, but the number was 600 million ounces. So we've got 600 million and 600 million. We've got about 1.2 billion ounces of silver that has been accumulated in the ETFs and the European dealers since 2005-2006. So since we know that these numbers account for all the silver that's being used, and it matches the total number of silver that's being mined, including that which is being melted for scrap, we know that the only line that this amount of investment silver could be coming from would be this implied net investment line here. So what we want to do is we want to go to the year 2005, and we want to add up this implied net investment. So we've got 50 and 50, say 110, 122, 140, 260, and then 360. And so with all these added together, we've got about, we'll say 440 million ounces from the year 2005 to the present, or through this time period. We've got 440 million ounces. Yet we just pointed out that we've been told that the ETFs and the European dealers have accumulated roughly 1.2 billion ounces of silver. So somewhere in these figures we are missing approximately 750 million ounces of silver. Where did that silver come from that the ETFs accumulated? It didn't come from, we can see that it didn't come from any of the areas that took this silver, and we add them together, we have 878 out of a billion. If we go and subtract these numbers, we can see it's nowhere near what they say they've accumulated. So there's some stuff that's really fishy in these reports, and the most fishy is the ETFs. I think that Sprott has his silver, but I have severe doubts as to whether the BlackRock JP Morgan ETF has any silver at all. And if they do, I sure would like to know where they accumulated it. And for the Silver Institute to cite this figure showing that European dealers hold nearly 900 million ounces of silver and yet not give any account of where this silver came from, how they accumulated it, because I certainly can't see from these numbers from the Silver Institute how it was possible for anybody to accumulate any more than 400 million ounces of physical silver between the years of 2005 and 2010. So we've got about 750 million ounces of mysterious silver that was accumulated, and there's a lot of other problems with it. So again, something is fishy here with the Silver Institute's report, and I just don't buy it, and I don't think you should, and it's probably why you should keep stacking physical silver, because I think when they finally do shine the light and all these cockroaches scurry for the corners, you're going to find out that the vast majority of them didn't have any physical silver. And we'll talk to you next time.